What's going on, folks? I hope you're excited because I know I am. It's been a hot minute. We've been so busy I can't even explain it. But here today, I've got 4 screaming buys right now out of dividend stocks, and I hope you're very excited. And maybe you consider buying these. Now, what do I consider a dividend stock? Well, I'm talking about some high yielders. We're talking about 3+% quality dividend stocks. Now we've got 4 here, obviously, for you today. 2 being very high yielders, and 2 others that are really just good dividend plays that have a good dividend growth story behind them. So I hope you're excited because we're going to start right off with one of our higher yielders here in Realty Income. Now, I say high yield because we're sitting around 4.5% on the dividend yield on this company. Not too bad. So why is Realty Income on this? Well, look, I like to choose recession-proof businesses. And you look, year-to-date, Realty Income hasn't fallen nearly as much as the total market, so that's a benefit that they've had. And it's just been a consistent winner throughout history. It's what they do. They don't move drastically like some other companies do. It's only down 8% year-to-date. And over the last 5 years, really only seeing a 22% gain isn't necessarily crazy, but it's a dividend play nonetheless, and it's a beautiful dividend play nonetheless. What is Realty Income? Well, Realty Income here is an investor who purchase properties and lease them out to tenants, right? These tenants vary from a wide range of different companies. And the main focus here is obviously this company's really focused on reinvesting or really rewarding the shareholder. And you can see here, they mention it right here, strong returns are a key thing. Because we have 15.3% compound average annualized total return since listing. That's right. We've got 4.4% compound annualized dividend growth. Beautiful. 624 monthly dividend companies. That's right, folks. This company pays monthly, and it is known as the monthly dividend company. And 99 consecutive quarterly increases. They're going to hit 100 next quarter. So I hope you're very excited about that because I know I am as a shareholder. Folks, this is the most consistent dividend payer out there nearly. It is quite beautiful. Since their 1994 listing, this company just pays dividends, folks. Now, why do I say this one is a little bit resilient? Well, the portfolio is pretty resilient when you talk about the businesses that they enter. First off, obviously several geographic differences here. I mean, we've got United States, and obviously they include some now in Spain, not much of the portfolio, but then you also have some UK as well, properties, 150 in the UK. Over 11,200 commercial properties in 70 industries, with an occupancy rate of 98.6%. People are leasing out these properties, and they've recovered pretty much entirely from where they were at. So if you look at the featured property and clients, which definitely I think we're going to look at. Why make this so difficult for me? Look at how slow this is. It's very slow. So leased nearly 1,090 clients. 1,090 clients. Is this something that's even possible? I don't know, but they did it. They just did it. Show me the clients. Where's the clients list? I'm telling you, they just. I can't tell you. They just updated this dang website. How dare they do this to me? Anyways, they're in a lot of industries that are really resilient to recession. Again, we're talking about gyms. We're talking about 7-Elevens, convenience stores, retailers, wholesalers even, with Sam's Club. This is really just movie theaters. They're pretty resilient. I mean, come on now. They invest in, they lease out to smart properties. I mean, smart tenants. That's what they do, folks. Anyways, we look at some of the other financials here. From a revenue standpoint, this is a company that doesn't stop winning, folks. They are winning massively on a revenue standpoint. You look at this since 2010. Just look at this chart. Do you see red anywhere? I don't. I see nothing but freaking green, baby. That's right, rough times, even at the end of, start of 2010, still rough times. Here they are smacking everything. Through 2020, when they had issues with clients not paying the rent, still growing. This is a company that is just beautiful. It's just beautiful when you look at this revenue, which means they're able to continue to fund this dividend because they're going to continue to bring in more and more cash. That is a lovely sign. I love Realty Income, and again, as I mentioned with those dividends, this is the main piece of the pie. It's just the main piece of the pie, folks. What else do you want me to say? We look at the dividends, and it's just beautiful, and it makes me very happy. Look at this. You can get all these reports, anything you want. That's right. They're not going to mess around with you. So that's why Realty Income is one of my stocks to buy here. I think it's a massive win for you, and you're going to love holding this thing in your portfolio if you are going to potentially have it in a retirement account or just enjoy monthly income. This is the stock for you, folks. Next is a scorching high yield because we're looking at Omega Healthcare Investors, okay? Now, this is a stock that's seen a little bit of turmoil this year. Again, only down 8.5%, but if you look 1 year out, this stock's down nearly 25%. And on a 5-year basis, down 19.4%. Now, this is a company yielding just under 10% right now. Needless to say, that's a ridiculous yield. I mean, what do you want me to say? Is 10% a great yield or what? And this is a company I don't believe is a dividend trap. I don't believe this is. Because we look at the fundamentals and you understand why. So first off, Omega Healthcare Investors, they invest in skilled nursing facilities and senior care. As you can see here, triple net equity REIT supports goals of the skilled nursing facilities and assisted living facilities operators who they finance out to. 64 of the most future-focused, growth-oriented operators in the U.S. and U.K. That is absolutely right, folks. So why is this an industry that I'm personally a fan of? Well, you look at it and we look, I don't know why I didn't have this queued up. The average life expectancy in the United States has continued to rise. I mean, it's continued to rise here. Obviously, this last number was 2019. And I think the overall numbers dropped in 2020 and 2021 by a year or two. And obviously, that's because of a global pandemic. But other than that, it still is a trend that's going to continue to rise as average births continue to decline as well, because people aren't having as many kids, which means the average age is increasing and people are living longer and longer, as you can see by life expectancy. This means the need for skilled nursing and assisted living facilities only will increase. It's only going to increase, and everywhere too. United Kingdom is the same story, folks. It's just the same exact story. So this is why I like this one a lot. And you look at the revenue here of this company, and they've been able to do great. The only issue here was in the first really start here of 2020, massive decline because a lot of their facilities were completely shut down. They weren't earning money from their tenants. Their tenants. They weren't paying the rent. So you saw a massive dip here. But since then, that's right. Not too bad. Not too bad here, folks. On a trailing 12-month basis, obviously you can see continuous rise here. Pretty well consistently in the green. A few reds here and there, but nothing crazy because you've seen them recover to a tremendous degree, obviously. And I just really like what they're able to do. I think this is an industry that is fantastic in the long term, and the dividend's well covered. You look really over the last 10 years, and this dividend did halt around 66 cents when you look at 2019. It halted around 66 cents, and then increased to 67 cents here in they were raising every single quarter, by the way, which is wild how they were able to do that. Then in 2019, they stayed at 66. Then in 2020, they went to 67. And even through everything going on, facilities shutting down, not getting the rent, they've been able to stay paying the 67-cent dividend. That's pretty wild. They didn't have to decrease the dividend like a lot of these other companies did that were paying extremely high yields. That shows this management team is highly focused, and they're able to get the job done effectively and manage the cash flow. I'm very excited about that, and I think long term this thing's beautiful, and you're going to get share appreciation on top of this beautiful yield of 10%. What can I say? Except you're welcome, folks. All right, here we get into a lesser yielding stock, but it is none other than Tapestry. Why do I like Tapestry? Well, look at this. First, you got to know this. It's a darn cheap company. $8 billion market cap. That's right, off of revenues over that. I mean, this is a price to sales under 1, significantly under 1 here. And PE ratio around 10. Around 10, yielding just over 3% right now. Year to date has seen a terrible decline here of 21%. The last year down 24%. The last 5 years has seen a 31% decline. Now, it's not quite where it was in the dip here of 2020, and thankfully, it hasn't reached that point, and it didn't deserve to reach that point ever, but here it was. So what is Tapestry? Well, you know the brands that they own, that's for sure. You know them from Coach, Kate Spade, and Stuart Weitzman. Do you see me? You see me shaking this around here? I'm shaking my money thing. So absolutely, these are some of the most iconic brands out there. Coach, Kate Spade, Stuart Weitzman. These are brands that find success no matter what, just due to the fact that there's so much loyalty towards these brands because of their high quality and really just the meaning behind these brands. They're able to charge premium prices and people will pay them because of the name brands. It's pretty freaking wild, folks. So obviously we saw a massive issue here in 2020 because non-essential companies, as the government decided what non-essential was, like retailers here that don't sell foods, were shut down. So that's why companies like Stuart Weitzman were struggling. These clothing companies, they couldn't do it. Clothing and accessories, they were completely shut down. They weren't making the revenue. So that's why we saw a massive dip. And it's since recovered pretty high. And then again, it's fallen down quite a bit since then. Well, look, this company's been able to consistently grow revenue. The only time we saw a dip here was 2020, and this is not unexpected. The stores weren't selling their products. They've since not only recovered to where they were pre-2020 levels, they're thriving way beyond that. Again, you're seeing prior to this $6 billion, now sitting at 6.67 in the previous quarter. When you're looking at trailing 12-month revenue, this is a company that is absolutely doing great things, okay? Very happy about them. And they're going to continue to do great things in this industry as well, just because of the name brands that they have right there. Let's just be honest. And I look at the dividend. This is a company that did unfortunately have to cut the dividend in 2020, and I'm not shocked because of that. I'm not shocked. Look, they weren't able to do business. There's no way they could keep the dividend flowing. So they haven't recovered to their 34-cent, what they were at prior to this. They're sitting at 25 cents, but if you look at it on a 10-year basis, again, this is a company that was, sitting back at this level at 2012, then they upped it to 30, then to 34, and that's set pretty consistently. Now, I do think they'll, within the next couple quarters, potentially the next quarter, raise this to 30 because that increased cash flow is coming back, and they're going to be able to consistently pay that, and this thing will be yielding yet again over 3%, and it's just a beautiful, beautiful thing to have 3%, plus a great opportunity to get some share appreciation. So that's why I like Tapestry. It's a great brands for this company in an industry that's just been hammered as of late. My final stock is the king of dividends, and it's Target, folks. Why Target? Just look at the stock. It's all you need to know. Down 37% year to date. Really all from the last month here. Down 33% in the last month. In the last year, down 39%. This is terrible stuff to see. 185% up in the last 5 years is fantastic, but this 39% dip over the last year is absolutely unwarranted. This stock's yielding right at 3% right now, and it's trading at a ridiculous valuation. Price to sales is close to 0.5 on this company. Can you believe that? It's around 0.6. That's ridiculous. PE ratio at 12. Now, this is an issue with the forward PE, that the forward PE is higher than the trailing PE right now, but we're still talking about around a 15. And this is because some of the issues they've had with inventory. This is where you see this big, massive dip last month here, was because they had to mark out and really mark down a lot of merchandise. They bought very heavily into hard goods like patio furniture and other very expensive furniture items, when what people were really buying here is still grocery. They're going crazy on grocery, stocking up, and they weren't buying that. So their inventory mix was just a little bit off. They bought a little heavy on some categories they shouldn't have, and they paid the price. Now, is that justifying a 35% drop in the stock? It's not. This company has done nothing wrong, in my opinion. You look at Target, they've got a great online delivery service, obviously, too, is a thing. I can't show the homepage because they've got half-naked women on there in their bikinis, but if I did, look, you know what Target is. We all know the retailer Target. Great stuff here. Online order is great. It's a great service they're going to continue to grow extra business from. E-commerce isn't the big play right now for Target. Look, it's not for the retailers. It was definitely the big play when you look 2 years ago when people couldn't go into the stores and didn't want to go into the stores, but now people would rather shop physically than do these online orders. Let's just be honest with each other. Majority of people want to go online or actually physically in the store and shop. Anyways, why do I love Target so much? It's because there's no problem with the revenue here, folks. There's no problem. Have you seen how much this thing skyrocketed in 2020 with people spending their stimulus checks? Yes, that spending will eventually decline. It's going to lower, but it's not going to get back to even pre-pandemic levels, not near. Pre-pandemic levels, this thing had a trailing 12-month revenue here. When you look at November of 2019, $77 billion. Right now sitting at $107 billion of trailing 12-month revenue. This company has boomed in revenue, $30 billion more in the last 2 years of them doing business. Last 3 years, sorry. 2.5. Let's be fair here. 2.5 years of them doing business. $30 billion increase in revenue. Now, even if that levels out, they're still doing exponentially more business than they were prior to 2020. How is this stock down 39%? I can't explain it to you, folks. I can't explain it. On top of that, the dividend just speaks for itself. 3.1% yield. 3% yield, as I said. Tiny payout ratio at 28%. 54 years of dividend growth. You heard that right. 54 years. This management team will not ever halt that dividend payment, nor will they lower it. 54 years of dividend growth. Ridiculous. 5-year growth rate, 8.45%. They just recently increased the dividend as well. We look at the dividend history. They just increased the dividend as well. What can I say? $1.08 from 90 cents prior. 18-cent increase in the dividend. This company is so focused not only on slightly increasing the dividend, because before they were only slightly increasing it. You look over the last 10 years, the growth rate has only increased with the dividend because they're just making so much money because of all the increased business, folks. This is an absolute buy. If you're not buying Target at these levels, you've lost your dang mind, and I'm not going to help you find it.